Welcome to The Educated Trader. I'm Dr. Alex Mosley, and I'm going to take you through the very basics of trading principles. This lesson is about the potential use of price action channels, that we may be able to discern when a market is trending. Again, this review is about whether we personally think that such channels may or may not be of use. In the previous tutorial, we reviewed what horizontal price support and resistance lines, or live wires as I call them, look like on the price charts, and noted how they sometimes create a price stickiness or a swampy area, as it were, as the bears and the bulls begin to take profits or line themselves up for new orders. We're going to see how an upward or a downward channel may also show supports and resistances, and also ask ourselves whether they may be used for a strategy, particularly for what I call not being shaken out of the tree when a market trends, and we want to stay in until we get some indication that the trend is ending. Also, there's a famous phrase in trading: the trend is your friend until it bends. Well, what does that mean? Perhaps a channel may be of some use to help us to see whether a trend has indeed finished. Well, let's have a review. Firstly, what is a trending channel? When a market is trending, showing higher highs and higher lows, as in the case of the bull trend here, identifiable channels may form, which capture the dynamic supports and resistances, or the floors and ceilings as they move up. Firstly, let's look at the important part of the bull channel, the supports, which are identified by the higher lows. Now this allows us to use a straight line that incidentally touches those higher lows. The highs of the channel can be taken as the higher highs, whose size and hence channel width is set by potentially the first two and confirmed by other higher highs. And this also allows us to note the upper boundary of the channel here in blue. Now note that the higher highs may not always reach the upper part of the channel. And this is just to show that there can be many variations on the theme of a trend, which we will explore in more depth in this tutorial. But also consider that while we have a run of higher lows, we don't always have the second part of the trending formula, the higher highs. The trend continues upward though. So that raises questions. Has the trend bent enough for us to pull out of the trend, or do the higher lows provide us with evidence to stay with the channel? The answer is not always clear-cut, but we always need to keep our thought on what rule should I create here for my strategy and tactics. Here is a bear version of the channel. Again, I am highlighting that the market does not always have to touch the boundaries. Yet there is a tendency to return to the channel boundaries once trending. The idea of putting a channel onto a graph can perhaps provide some representational structure which traders may inadvertently and surprisingly respect. Or not. You can never tell. But when they do respect what is just a couple of lines drawn on a graph, indicating a connection between highs and lows, it is interesting and may have some use for us. Let's have a look at how we may start a channel, from which we can begin to evaluate how useful a channel graphic may be. Let's say that a market has been consolidating or potentially just starting to turn around. There is a new high and a new low. Tentatively, we could try deriving a channel at this point. We have 3 points, which may turn out to be premature, but that's true of any indicator that we may deploy. Markets will do what they do. They don't conform to what we scribble on our charts. But let's say that we're hoping this will trend long and we want to squeeze as much from the potential trend as possible. Using the 2 lows and the high as our starting point, the triangulation, we can extrapolate a lower channel line from the lower lows and use the high as the width of the potential channel. Now, brokers' charts tend to offer a channel tool which automatically creates these parallel lines. We now have a sense of structure that may be of assistance to us. Well, let's see what could happen in an ideal world. In this example, the market trends within our channel, respecting the boundaries. Lovely. But of course, that does not necessarily have to happen. Here, the upper channel is breached. Still, it produces a pleasant bull move to observe, but then the bear reply is brutal, and the market pushes below the previous low and our lower channel boundary as well, before moving back into the channel. Does the channel have a meaning here or a use for us at this point? Do we write off all channel analysis, or do we just say, well, this one didn't happen? To a great extent, it depends on the frequency of channels behaving well for our particular market, or for any market, and that may be a different thing over time. Let's have a look at some historical examples. Here's a good example showing an almost perfect channel, with just a slight peaking above the higher line, the higher boundary, a couple of times. But what I find remarkable is how the angle of the market's trend is respected during the bull move. From the original triangulation, we can stretch out the channel tool, which conveniently on ProReal charts has a halfway path as well to follow, which we can see price action is also attracted to. It's not that the channel we draw causes prices to become sticky around the median or the middle path, of course. I mean, who are we compared to the market? But price action repeats sufficiently enough to create what we see as an interesting pattern there. Let's think of an analogy that may be useful. Consider a person taking a dog for a walk. Her displacement from where she starts is the median path, in the middle. She walks at a constant pace, the angle given here, while her dog sometimes lags behind and sometimes races ahead. She creates the trend pace, and it's only broken when she either stops to talk to someone or turns to go home. Let's look at a couple more examples. Here is a short-lived channel on the pound dollar, which touches on the lower channel once and the higher again, before collapsing out of the channel. We set the potential channel up with the higher high and the following higher low, but note that we are beginning to recognize that the initial upward movement has its own higher highs as well and higher lows, creating a short bull run. So, is this a fair assessment of where to place the opening channel? Of course, we are looking at this after the fact, historically so, which means that we can fit the line onto the data. We must always bear that in mind, otherwise we are making a statistical fallacy. The next question that this example raises is whether the trend ends at the top of the move or on the breach of the lower channel. Our first instinct may be to say on the breach of the channel, but we can also note that the market reacts very strongly to the upper channel that we've created and proceeds to crash through all the previous higher lows of the bull move up. Does that reckless crashing through the previous lows constitute the bend that we're looking for? A problem with the notion of crashing through the previous pullbacks or the pivots is that during a trend this can happen and we can still have an upward moving trend. Do we want to be shaken out of the tree here, or do we want to stay in? The breach of the lower boundary certainly has more of a trend failure quality about it. The market fails to get back into the channel. The question for us to consider for strategy or tactical purposes is what rule can we create to exit the market? Leaving our exit to the breakthrough of the lower bound means giving up some of those profits. Taking the trade out as it breaches previous pullbacks on the way down may mean missing out on a return to the trend, should that happen. There's no easy answer for this as we begin to create our own strategy, of which we are the creators. We create the rules. So long as we're happy with the choice overall and we stick to it, it will never be perfect, but it gives us something to consider. This is an example of a bear move on the dollar-yen. A lower low is formed, giving us the apex of the triangle, which is then completed by the lower high. This permits the channel to be drawn, which is generally respected on the way down. Now note that the market breaches the upper channel, and our dog, as it were, gets a bit far from its owner at this point and is called back, after which the dog behaves quite well and stays close to the owner's path. Also note that the lower lows do not always touch the lower channel that we've formed, except that the last one does. Note how the market also sticks quite close to the middle path towards the end of the section. Here's a scrappy one, ostensibly not worth anything to us as it unfurls. There's a bit of respect of the lower channel, but then that is broken while the bear move continues. But note how the breach of the lower boundary continues to follow the trend, before commencing a strong bull move that breaks through the entire channel. I get the impression that this dog is either high on a windy day, or its owner is out in the fields and the dog's doing its own things, rabbiting or something. However, let's have a look at the following bull move that's created here and see if that is in a channel. Wow. Now the formation of the bull channel from the previous slide begins in earnest, and the market behaves well. It ploughs through the descending channel, which, if we were playing short, prompts some questions. Would we have two trades open here to see which of the conflicting trends wins out? Or do we wait till the upper bound of the descending channel is breached to get in on the ascending channel? When two indicators are providing different directional signs, we call that a divergence. Hunger Games and all that. Divergence can be noted on many pairs of indicators, and we're seeing a simple version here. And don't forget that we are reviewing these historically. In a live market, it is much harder to make sense of inconsistent or contradictory divergences. Sometimes they can begin to mean something, but other times they do not. In this example, we do not know whether the channel was going to return to the bear trend or not. It could well have, and the emerging bull trend channel could have been meaningless. It's always a game of interpretations and creating rules to help us, but for now, remember that our channels are drawn after the fact. That is, we may be able to spot some very nice channels once they've finished, but that's no good for our market analysis moving forward into the future. So let's test it out and get a feel for how often a channel may arise by avoiding a peek at what will happen next. To do so, I'll take the edge of the last screenshot and see where it takes us. So in this example, we have a high and a higher low, so we can paste on the graphic the triangulation and the potential ascending channel. Having done that, we can now fast forward and see what happens. Well, it didn't get very far. It hit 11,200, which acted as a ceiling, and the trade went sideways, breaching the channel. Let's try another move, following the screen forward for the next potential trend. This one, occurring not long after the previous, exhibits a shallower channel compared to the previous. But let's see what it does. From here I can stretch the graphic forward and see if it's been respected or not. Well, that's not bad. This one has an entertaining ride by poking through both the top and the bottom of the channel, while maintaining a similar angle of the trade, which is kind of the speed that the market is trending. Now, we have to be aware this is based on the setup that I have here, and that angle that we see that it's ascending at can be altered by fiddling with the axes. I wouldn't recommend doing that too often, because then you can't compare previous trend speeds with other trend speeds. Now what we could do here, because we've got some poking out of the upper boundary and the lower boundary, is to acknowledge the increased breadth of the channel by expanding the current channel that we're playing with, or superimposing another one on top, which I shall do for the sake of illustration. Now we can ask, is this useful? Or do we prefer to see the narrower, original trend channel as our reference for where our dog has wandered? Do we give Fido a wider range of action, or prefer to keep him close to us. Now, after all, we only want a frame of reference. Let's try one more. Here's another setup, this time short, following the previous bull move. We have a setup and we can create a channel to see what happens. Well, that goes off target quite quickly. Nonetheless, it does continue the bear trend. It's also as if we could add an alternative channel here, but again, that is after the fact. And while this new channel is parallel to the form and the market seems to behave well in it, it would have been quite difficult to set it up at the beginning. Let's have a look at a few more examples. This first one shows a good bull trend, but the channel is barely respected by Fido on his walk. The second shows several potential channels occurring based on the triangulations that we can see. But overall, we are getting some mixed messages here. And when we have mixed messages, we either have to clarify what we are doing or drop the idea as being currently or completely useless. For altering our channels, do we then expand them to take in new starting points, as it were? Now, this chart, based on the previous one but expanding it, looks pretty neat, but again, that's after the fact. We're imposing the pattern afterwards, which does give it very little utility for us. Looking carefully at the bear trend, we can see that there is respect for an upper boundary, and indeed, we may have been able to form an even narrower channel around point A. But that turns out to be more than halfway through the trend, and there is no way that we would know we were halfway through the trend at that point. The second possibility is to alter the width of the channel or the angle as we go along. Firstly, we have the opening bear channel, which respects our tentative channel once before it wanders off long. Secondly, the breakout hints at a bull channel opening up, but as we can see, this breaks the lower bound of the channel rather quickly. Now this allows the setup of the third adjustment, which works reasonably well. It tests the upper boundary, but does not set up a counter-trend bull move. It just keeps on going. Nonetheless, we can perceive an adjustment to the speed of the bear trend here. This can allow us to consider placing a new bear channel that we can see as the market returns to its channel. It creates a new set of lower lows, noted at the bottom of the rectangle I've put on here, but the market's angle is much shallower than before. A new triangulation becomes available, allowing us to impose this secondary channel, which is rather respected apart from one little aberration. Following that, however, we have a strong move to the bull side of life, and this channel turns out to have a consistent angle, but its breadth has a problem. So we could alter its height to reflect the new high that has been reached. This new broader channel is respected very well and maintains the same angle as before. This is the speed of the market momentum, before it too begins to break down at the right of the screenshot. So regarding these channels that we've been looking at, we can see that markets sometimes do act within them. If we believe that they may be useful, the initial problem is identifying when they've actually started. 3 data points might be insufficient or too early to create a meaningful channel. Alternatively, we could wait for more data points, but by which time the trend may have started to fail, and we've reduced the power, the profitability of any strategy we have. But there is also the option of making adjustments to the breadth and or the angle of the channel, as we've been doing the past few slides. Now, whether the channel tool is useful or not as an indicator of how markets may behave going forward is for us to decide. Just remember, dogs off the lead can stray quite far before coming back to their owners. Now that completes the first set of basic lessons for the budding trader. In these 4 lessons, we have touched on the fundamental skills that we all need when reviewing the price charts, and which never really leave us. Firstly, being able to read the price charts and playing with them visually until they suit our needs. Secondly, being able to spot the main market types, the bull markets, the bear markets, and the sideways markets. Thirdly, being able to review the usefulness of a basic indicator, and we looked at price supports and resistances. And fourthly, in this tutorial, we reviewed the usefulness of trending channels. We find again and again that while patterns are discernible, nothing is ever certain in the markets. Old supports and resistances can be crashed through, and channels can widen or change angles or just disappear. Volatility may be just around the corner and none can predict it, unless of course they're the size of a massive institution about to dump or buy a huge percentage of that market. We are forever facing questions about how we should trade in this constant flux that we watch. And in my course on how to create your own strategy, I go into more detail about how we can systematically review the questions and hence help us begin to converge on something that could be of use to us. A working system, a strategy and tactics. Thank you for listening. I'm Dr. Alex Mosley from The Educated Trader.